So imagine you open up, a traditional conservative value ETF.
Right, you're expecting the usual suspects.
Exactly. You're bracing yourself for a roster of regional banks, some legacy industrials, utility companies.
The boring stuff.
Yeah, the boring, reliable stuff. But instead, you look at the top of the holdings list, and you find Nvidia and Apple sitting right there.
Which is just, I mean, it completely throws you off.
It really does. You double-check the label, and it clearly says value, but under the hood, it looks like this tech-heavy, massive momentum play.
And that right there, that forces you to completely rethink how we even categorize funds in the modern market, you know? The old boundaries between, like, growth and value, they are blurring so fast.
They really are. And that's exactly what we're tackling today. Welcome to today's deep dive. We are putting a massive, really fascinating anomaly under the microscope. We've pulled data from fund prospectuses, annual reports, and side-by-side market comparisons.
Lots of reading for this one.
Oh, tons. Our mission is to decode the SEI QiM U.S. Large Cap Value Active ETF. The ticker for this one is SEIV.
Right, SEIV.
And it's managed by the SEI Investments Management Corporation.
Right.
But specifically, it's driven by their quantitative investment management team, or the QiM team.
Right, and that QiM part is, well, it's the whole secret sauce here.
Exactly. So just to set the stage for you, we're looking at a fund with roughly $1.5 billion in assets under management. Its core mandate is to invest at least 80% of its net assets in large-cap U.S. equities, basically playing in that Russell 1000 sandbox.
Yeah, but the defining characteristic of that QiM team isn't just that they buy large-cap stocks. It's their strict, rules-based, quantitative selection process.
Right. No humans picking stocks.
Exactly. They aren't relying on, fundamental analysts sitting in a room writing these long discretionary research reports on individual companies based on gut feelings. The portfolio is entirely algorithmically driven.
Which brings us right back to that initial paradox. We have this fund. It's heavily concentrated. About 128 holdings.
Pretty tight list.
Yeah. You scan the top names, ensure you see your classic value anchors. General Motors is there, Verizon, Cardinal Health.
Your stuff you expect.
Right. But then, boom, Nvidia is sitting there at roughly 3.4% of the fund. Apple is at 3.2%. Alphabet is heavily represented, too.
It's wild.
Mega cap tech makes up over 11% of this portfolio. So, okay, let's unpack this. If the algorithm is supposed to be hunting for value, how on earth do the most expensive, high-flying tech stocks on the planet make it through the filter?
It's a great question.
Like, doesn't holding massive momentum stocks completely defeat the premise of value investing?
Well, what's fascinating here is that assumes value investing is just a simple, sort by lowest PE ratio kind of exercise.
Like an Excel spreadsheet sort.
Exactly. But the QiM algorithm operates on a much, much more complex, multi-factor scoring system. SA's primary exposure absolutely is to value. Okay.
The model is aggressively screening the universe of stocks for companies that are underpriced relative to their fundamentals.
Yeah.
So it's looking at metrics like free cash flow yield, earnings, sales.
The classic metrics.
Right. But the nuance, and this is key, is that it actively manages secondary risk controls simultaneously. It does not look at value in a vacuum.
Ah, okay. So it's not just a binary, like, is this cheap, yes or no filter. It's building a composite score.
Precisely.
Break down the mechanics of those secondary risk controls for us. How is the algorithm actually weighing these different factors against each other?
So the quantitative engine, right, it screens the entire market for momentum, quality, and low volatility right alongside those core value metrics.
Okay, so a bunch of different lenses.
Exactly. Rather than just skimming the cheapest 50 stocks off the bottom, the algorithm calculates a composite ranking for every single stock in the index. It assigns statistical weights to these factors.
So it's grading them. Yeah. So if a stock has, say, an incredibly attractive valuation, it's super cheap, but it has terrible price momentum and its quality metrics are deteriorating, like maybe its return on equity is tanking.
A value trap, basically.
Exactly, a classic value trap. The algorithm actually penalizes its overall score for that.
Wow. So it's actively screening out value traps by using quality and momentum as a kind of shield. Because, any informed investor knows that a rock-bottom price-to-book ratio often just means the market has correctly priced in a dying company.
Exactly. It's cheap for a reason. By layering in those quality metrics, the algorithm prevents the fund from, catching falling knives.
That makes a lot of sense.
And it works in the opposite direction, too, which actually answers your question about Nvidia and Apple.
Right, the tech paradox.
Yeah.
Yeah.
So a company might look slightly expensive on a traditional value metric,
Mhm.
but if its quality score, think like massive cash flow generation, high profitability, if that quality score and its momentum score are completely off the charts, the overall composite score pushes it above the threshold for inclusion.
Oh, I see.
The algorithm basically allows the fund to hold market leaders that act as heavyweights. It drives broader market momentum and effectively balances the risk profile of those traditional, slower value holdings.
It's almost like it's like building a high-performance vehicle.
Okay, I like this. Go on.
Well, your classic value metrics, those low multiples, high free cash flows, that's the heavy, durable engine block. It gives you the core, reliable power.
Right.
But if you just drop a heavy engine onto a rigid chassis, you're going to feel every single pothole on the road. The ride is going to be terrible.
Absolutely.
So those momentum and quality screens, they act as an active suspension system. You get the power of the value engine, but the momentum factor absorbs the market shocks when growth sectors take off. It keeps the portfolio moving smoothly.
That is the perfect way to visualize it, an active suspension system, because SEA is not a passive value index. It's not stubbornly holding on to yesterday's losers while praying for a mean reversion that, frankly, might never come.
Right, it's not stubborn.
No, it's a live, dynamic system. It's constantly recalculating the optimal mix between value, quality, and momentum based on daily data inputs.
But wait, building and running a live, dynamic quant engine that constantly recalculates scores across the entire Russell 1000 that requires serious infrastructure.
Oh, massive infrastructure.
Usually when you see words like quantitative or active multi-factor optimization in a prospectus, you brace yourself for a massive management fee.
You expect to pay up.
Yeah. But looking at the sources, the pricing here is incredibly aggressive.
It really is. The total annual operating expense is 0.15%.
Just 15 basis points.
Just 15 basis points.
And the documents even note that net fee waivers can sometimes push the daily operational figures even lower than that. But let's just stick to the stated 0.15%. That completely undercuts the market.
It's unheard of for this kind of strategy.
I mean, the average actively managed U.S. ETF charges somewhere around 43 basis points.
Right. So offering an active proprietary algorithmic trading model in an ETF wrapper for 15 basis points, that is a very deliberate strategy by SEI to capture market share.
It's a land grab.
Exactly. Because historically, if you wanted to access this level of sophisticated multi-factor quantitative screening, you were paying hedge fund fees.
2 at 20, right?
Yeah, or at the very least, you were paying premium mutual fund fees. So pricing it at nearly a third of the industry average for active management, it completely changes the math for portfolio constructors.
It does. But, whenever the sticker price on something this complex is that low, my immediate instinct is to look for the hidden friction costs.
Naturally, you got to look for the catch.
And combing through the annual reports, the catch isn't in the management fee, it's in the turnover rate.
Ah, yes, the turnover.
Hey,
Because that active quantitative rebalancing we just talked about, it inherently generates a lot of trading activity.
A ton of it. The sources show an annual portfolio turnover rate of roughly 60%.
Which is significant.
Yeah, so that active suspension system is constantly adjusting. It's swapping out components, buying, selling, all just to maintain those optimal factor exposures. And we know that a 60% turnover creates a tremendous amount of dust.
And in investing, that dust is taxes.
Exactly. The tax friction.
It's a critical component of evaluating this fund's total cost of ownership. Because if the algorithm is selling 60% of its holdings every single year, it is constantly realizing capital gains.
Right.
Now, in a tax-advantaged account like an IRA or a 401k, that friction is contained. The turnover doesn't trigger immediate tax liabilities for you.
But if you hold this in a standard taxable brokerage account, those realized gains get passed straight through to the shareholder.
Yep. You get the bill.
So you might be saving 28 basis points on the management fee compared to the industry average, but you could easily lose way more than that to the IRS just because of the constant rebalancing.
Exactly. Which is why asset location is absolutely vital if you're going to utilize this strategy. You have to map the fund's mechanics to your specific account structure. Right.
The active nature of the strategy is its main selling point. But that algorithmic activity is not free, even if the expense ratio kind of makes it look like it is.
Okay, so you've got this sophisticated multi-factor suspension system. You're paying a highly competitive management fee, but you are accepting a premium in turnover friction to maintain it.
Right.
The obvious question then is, does the vehicle actually win the race? Because a 60% turnover is really only justified if the algorithm is generating serious alpha.
You have to get paid for that friction.
Exactly. So let's look at the historical performance scorecard.
And honestly, the recent metrics really validate the strategy's design, especially in the context of the broader market environment we've been sitting in.
Yeah, according to the latest performance reports we looked at, SEIV delivered a stellar one-year total return of roughly 36.59%.
That's massive.
It is. And some of the data points even stretch as high as 39%, depending on the exact cutoff date used in the various reports.
Right, depends on the month end. Exactly. And the year-to-date performance sits around 15.28%. Since its inception back in May 2022, it has generated really impressive double-digit annualized returns.
Consistently outperforming its primary benchmark, the Russell 1000.
Yeah, but we have to look at why it won, right?
We really do have to unpack the attribution of those returns, because traditional value factors, they have essentially been flat over the past year.
Yeah, value has struggled.
The broader U.S. large-cap market has been entirely dominated by the mega-cap tech and AI narratives.
So if SEI had operated as a pure, rigid value fund, if it didn't have that active suspension system, it would have lagged the market terribly.
It would have been a disaster. It would have been stuck holding legacy telecom and energy while tech just ran away with the index.
But its momentum factor positioning was the key driver of that 36% return.
Exactly. The annual report highlights some really fascinating contributors to the fund's outperformance. It specifically points to companies like Micron Technology and NRG Energy.
Which is just a perfect illustration of the algorithm at work. I mean, Micron Technology is a memory chip maker, right?
Yeah.
They saw unprecedented demand for their high-bandwidth memory chips, which are critical for AI data centers.
Right. Massive momentum there.
And then NRG Energy, that's a utility supplier. On the surface, the utility company is a classic, boring value play.
Super traditional.
But NRG benefited immensely from the massive electricity demands of those exact same AI data centers.
It's brilliant, really. The multi-factor model recognized the surging momentum in AI beneficiaries across entirely different sectors.
It wasn't just looking at tech.
No. It captured the direct tech upside through Micron and the secondary infrastructure upside through NRG Energy. It allocated capital toward that momentum while still maintaining its primary value framework.
Wow.
The algorithm successfully navigated an environment that was deeply, deeply hostile to traditional value strategy.
It's a great narrative. And I mean, the numbers are undeniably strong. But we don't build portfolios in a vacuum.
No, we don't.
To truly evaluate SEIV's utility, we have to put it in the ring with the industry heavyweights. We have to see how it stacks up against the alternatives. Because if you're looking at your portfolio right now and trying to figure out where a fund like this fits, you have to weigh it against the giants.
Portfolio construction always comes down to relative choices. What's the opportunity cost?
Exactly. So let's run a side-by-side comparison. A three-way heavyweight bout.
I love it.
Let's match SEV against two massive competitors in the ETF space. Let's start with contender one, VOO, the Vanguard S&P 500 ETF.
The juggernaut.
The ultimate passive giant. Roughly 500 holdings, a microscopic 0.03% expense ratio. It provides pure, unhedged market cap exposure, no active management, zero factor tilts.
It is the default core equity holding for millions of investors, primarily because it is ruthlessly efficient and incredibly cheap.
Okay, then we have contender two, AVLV. That's the Avantis U.S. Large Cap Value ETF.
Now, this is a much closer peer to SE.
Right. It's an active multi-factor ETF that focuses on low valuation, but pairs it with a strong emphasis on high profitability, basically capturing that quality factor.
Right.
It holds a broader basket of about 275 stocks, and it charges the exact same 0.15% fee as SEIV.
Avantis runs a highly respected active approach. Their methodology casts a wide net to capture robust, profitable companies across the entire value spectrum.
And finally, contender three, our focus today, SEIV. Active quantitative multi-factor screening. Much tighter concentration, only about 128 positions. Prioritizing value, but strictly enforcing active momentum and volatility risk controls. Also at 15 basis points.
Okay, the stage is set.
So let's debate the capital allocation. I'll ask you directly. If you already own VOO and you're paying a microscopic 3 basis points for exposure to the largest companies in the U.S., why would you allocate capital to SEIV and pay 5 times the fee?
It's a fair pushback, but
Yeah.
here's the thing. With VOO, you are accepting the full, unmitigated impact of market
You're
drawdowns.
just riding the wave.
Exactly. Cap-weighted passive indexes give you the dizzying highs of a tech boom, but they also force you to ride the wave all the way to the bottom when a correction hits. There is zero active risk management. You are essentially strapped to the mast of the ship.
You own the whole highway, including the traffic jams and the potholes.
Yes. By paying that extra 12 basis points for SEE, you are hiring a highly advanced quantitative GPS system to actively steer you around the potholes. The low volatility and quality screens are designed to provide downside protection that VOO simply doesn't offer. You are paying for a dynamic risk hedge.
Okay, that makes sense for the passive versus active argument. But let's look at AVLV.
Sure.
If an investor is already convinced they want an active multi-factor value fund, and both AVLV and SEIV cost 15 basis points, how do they choose between the two? I mean, AVLV gives you 275 stocks, SEIV gives you 128.
It really comes down to conviction and the specific factors you want to target. AVLV's broader basket leans very heavily into profitability and cash flow. It's a fantastic strategy for capturing a wide swath of quality companies, but it's a wider shotgun blast. SEI's concentrated portfolio of just 128 stocks means the quantitative model is taking much higher conviction bets.
It's forcing the algorithm to be pickier.
Exactly. If you only have 128 slots, a company has to score exceptionally high across all the composite metrics to make the cut.
Oh, that makes sense.
Furthermore, SEIV places a much stronger explicit emphasis on momentum as a risk control than your typical profitability-focused value fund. If you want a portfolio that actively chases market leaders to hedge its value exposure, SEI's tighter concentration and momentum integration might be the more appealing tool.
So to summarize about for everyone listening, VOO is for the investor who just wants to own the market as cheaply as possible and is totally fine stomaching the full volatility.
Yep.
AVLV is for the investor who wants a broad, active, quality value tilt. And SE is for the investor who wants a concentrated, dynamic approach that actively uses momentum to try and beat the passive indexes without crossing over into that high-fee mutual fund territory.
That accurately defines the distinct utility of each strategy within a broader asset allocation framework, yeah.
But, as with any highly advanced technology, you have to trust the programming.
That's the kicker.
Which brings us to the macro outlook and the inherent risks of this strategy. How does a fund heavily reliant on momentum and quality screens actually adapt to different economic cycles?
Well, theoretically, the adaptability is its greatest strength. Because the factor weightings are dynamic, the model shouldn't get stuck stubbornly holding on to a single thesis.
Like we saw last year.
Right. If we enter a sustained period where growth heavily outperforms value, the momentum factor should catch enough of that upside to keep the fund competitive.
So it won't just go down with the value ship out of spite.
Exactly. And conversely, if the market crashes into a recession, those quality and low volatility screens should provide a cushion by filtering out highly leveraged companies with deteriorating cash flows. The model is built to survive regime changes.
Okay, but the primary risk here isn't necessarily a bad company then. It's a bad line of code. We really have to discuss quantitative model dependency.
We do. It is the central vulnerability of any algorithm strategy.
Right.
The model is trained on historical data and observable market patterns, If the market experiences an entirely unprecedented event, a true black swan that behaves unlike anything in the historical data set, the algorithm might completely misread the signals.
It's like the GPS drives you right into a lake because the road washed out 5 minutes ago and the satellite hasn't updated.
That's a perfect analogy. If the model fails to adapt, or if multiple factors break down simultaneously, the fund will suffer. When you buy SEIV, you are entirely dependent on SEI's QiM team maintaining the edge and the accuracy of their mathematical model. You are putting absolute trust in the architects of the algorithm.
Add in the very tangible risk of the 60% turnover tax drag we discussed earlier, and I think the profile of the target investor becomes very clear.
Very.
Based on the sources, SEIV is best suited for an investor seeking core U.S. large cap exposure who isn't satisfied with blindly tracking a passive index.
Right.
You want a hybrid value and momentum strategy, you want institutional-grade quantitative screening at a retail-friendly fee, and crucially, you have the right tax-advantaged account to hold it in.
Yep. And fundamentally, you are comfortable handing the steering wheel over to the machines.
Which actually brings us to a fascinating macro observation to close out today's deep dive. We started this whole thing by looking at the staggering $13 trillion global ETF market.
13 trillion, it's just hard to even fathom.
Right. But our sources noted that actively managed ETFs have recently captured roughly 25% of all new inflows. Investors are actively seeking out these complex engineered solutions.
The landscape is definitely shifting. I mean, the tools available to the everyday investor now are orders of magnitude sharper than they were even just a decade ago.
And as low-cost, emotionless, purely quantitative models like SEIVs continue to evolve, they are processing live data and executing rebalancing strategies faster and more efficiently than any human portfolio manager ever could.
It's true.
It really forces you to wonder about the end game of this trend. Are we approaching a future where traditional human stock picking becomes entirely obsolete? Are we looking at a financial ecosystem that will soon be guided entirely by dueling algorithms, just machines optimizing factors against other machines, leaving the old school fundamental analysts completely in the dust? Something for you to think about until next time.